got a couple of viewer questions. So we've got one from John that I think is relevant to a lot of people at the moment. So he's wanting to invest, but he feels there's a lot of uncertainty, and he's wondering whether he should invest now or wait till the picture's clearer and then jump in the market. Well, let's assume John's a long-term investor. What would you guys say to that?
Yeah, look, this is a perennial problem we have from a lot of people coming to us. I often take this view for people saying, well, if you were invested, would you get out at this point? And that's often a key thing for people to at least crystallize in their own mind about what they should be doing. Because if you were invested and you wouldn't get out at this point, then you probably should be invested now. If John was coming to us and saying, I've got whatever, 10, 20 grand sitting in my sitting in an account, and I'm going to be adding, a few grand a month into that, or a few grand a quarter into that. I'm just going to be investing, over the next 10, 15 years. Then I'd be saying, well, it doesn't really matter that much. Your initial investment, you're actually getting that savings habit going and getting that money coming in, and that, because you're going to average out over the next 20 years your entry point. So again, in that point, I'd say, look, just get started. The problem's always when people have this big cash amount, they're sitting there and they're saying, they've just sold a house or a business or something, and they're sitting there going, look, I've got whatever, a couple $100,000 sitting here. I want to put that in. I'm going to be adding a little bit over time, but really I've got this big amount and I don't want to invest right at the wrong time. The danger is there's always something out there that you can be concerned about. What I generally say to people on those situations is, look, you need to have a default position, which is you are going to invest. And your default position is you might be investing over a period that you feel comfortable with. And I'm saying, look, I want to be, I've got this big amount. I want to be fully invested within, say, 2 years, or fully invested within 12 months, or whatever the time frame is. And set yourself up to say, okay, I'm just going to start putting that in. Once a quarter, I'm going to say, say you've got your 200,000, you're just going to go, I'm going to put in $50,000 a quarter. And if the market does crash, then I can always speed that up. If I feel really nervous, you don't have to follow it. But what you want is your default position is you are actually starting to invest and starting to get into the market. Because I think at that point, otherwise your default position is I'm waiting until everything is perfectly right. The danger is you just never invest, because nothing will ever be perfect, and you never have the market fall to this level and people ringing the bells and saying, there's no more, nothing more to worry about. Now is exactly the time to get in. It's just not going to happen. So set yourself a default position, which is I will become invested, and then manage that. You don't have to follow it, but it's much easier if you've sort of already set up your direct deposits or your B payments or whatever into your savings account. And your investment account, and then because that will give you a much better chance of actually being invested, regardless of the scenario.
Yeah, thanks, Damien. I think that's a great answer, and yeah, that's how I'd answer as well. I think it's important to build that habit of regular long-term savings into whatever investment you choose to make, and get compounding, get that working for you. So, John, I hope that helps, and I hope that's relevant to anyone else out there with the same sort of dilemma.
And actually, one other thing I should add to that as well is, assuming they're talking about investment in us, I guess that was sort of a general case about whether you're investing in anyone. Keep in mind, if you're looking to invest in say, Nucleus, we're also in our tactical funds, we're also doing that for you as well, in terms of where we're cashing up and then moving out. And the danger you get sometimes is that you're basically doubling up on that. And so we're being conservative, you're being conservative as well. And so you end up being ultra conservative, and then and missing even more of the concerns when, like, even though we're quite conservative, we've still got investments in the market, and we're still generating returns for customers in case we are wrong, or in case things happen that new variants or other sort of windfalls that can drive markets higher. So yeah, just that danger of doubling up too much on that investment decision.
Yeah,